You got $90,000 worth of equity left in your home, and you can use that for whatever you want, or you can just let it be. But let's say push comes to shove, you need something. Your kid wants to go to college. You actually make too much money for them to get federal aid. They got a few scholarships, but it's not going to be enough. Maybe you use the equity in your home to do that. But that's a reason that you can have. That's another reason for you having a home and home ownership. Also, talked about monthly payments a moment ago. So if you got monthly payments on that, when you have a home, it's relatively stable. Yes, your mortgage payment can change a little bit over time. Absolutely, it can. But if you get a fixed rate loan, that particular portion is going to stay the same. Why does your mortgage payment change, or could it change? Well, it changes with a couple of factors. If you escrow your payment, which means you're going to put the insurance and you're going to put the taxes, the property taxes, in your payment. So your payment is, $1,500 a month. If it's $1,500 a month, that includes your taxes and it includes your insurance. Now, your what you finance, that portion should stay the same. However, let's say your insurance rates change. Maybe they change for the worse. Your payment might go up, right? If your neighborhood starts to go down, there's 4 fires that happen around your neighborhood. Insurance company may say, hey, this is a little more risk than we originally evaluated. Your premium may go up. That's all included in your payment, so your payment might go up. Property taxes, we already know, especially if you're already a homeowner, those things can fluctuate, and typically they're going up and they're not going down. So if they're reevaluating in your area every 2 to 3 years and your property value goes up and your property taxes go up a little bit, then that might change your payment a little bit. For the most part, though, it's going to be pretty stable. It'll be pretty stable. Now, conversely, your payment could potentially go down, right? I talk about you getting your credit together. Let's say you bought your home and you were able to buy a home when you had a 580 credit score, or you had a 600 credit score. You were able to buy your home. Now you've been listening to the 800 Credit Score Man show, or you called me at 312-600-5855, and you became a credit client, and now your credit score is 750. Your credit score is 780, whatever it is. You've improved. You call your insurance company and you say, I need a reevaluation. Your credit's better because they take into account your credit score as well when they calculate your premium. Your credit's better, and then maybe your premium falls. So if that premium falls, then also your mortgage payment can fall as well. So those things happen when it comes to it. Now, if you were in an apartment, conversely, you're in an apartment, every year they're going to raise your rent. Every time you renew that lease, they're going to raise your rent. Whether it's $25 or $50 or whatever it is, they're going to raise your rent, and you gonna have to pay it. This is where you live. You just have to take that on the chin, and you got to pay that extra money wherever it is. And sometimes it's a modest amount, and I would say $20-$25 is a modest amount. But $50, $100 is not necessarily a modest amount. Maybe you didn't get a raise with your job, and you're still making the same money you were making last year, and but your rent's going up, so your expenses are going up. So there's definitely benefits to having a mortgage and having your own space in your own home. Also, let's talk about some more financial stuff. The tax benefits. Yes, absolutely, there are tax benefits that come along with being a homeowner. So what do I typically say? I say that your credit score is going up, you're going to pay less interest, and it's going to save you money. So all of this helps at the end of the day. You're going to be saving money. So when it comes to these taxes, you have a tax write-off. So a lot of people that are living in apartments, they're paying a lot of taxes. They can make a lot of money, but if they're living in an apartment and they don't have a lot of deductions, then they're paying a little bit more in taxes, right? And maybe not a little bit, maybe a lot more in taxes. But when you have a home, you have the ability to write off the mortgage interest and those property taxes that we talked about. You have that advantage. You're able to do that, and it cuts your tax bill. So if your tax bill was going to end up being $10,000, but you paid in property taxes and insurance $11,000. So now you're talking about you overpaid basically $1,000 if it's one for one. You overpaid $1,000. Let's just say it's even. Your tax bill would have been 10 grand, and that's basically what you pay for your property taxes and insurance. You pay 10 grand, so now it's a wash. You don't owe the government anything. They may not owe you anything, but you don't owe them anything either. So that property tax benefit is absolutely one that you want to take advantage of as well. And then there's other advantages too. You get tax credits for environmental or energy efficient stuff that you buy for your home. When you're out shopping for that washer and dryer, that refrigerator, or whatever it is, there's energy efficient ones out there. Pretty much all of them have a rating on them. You can actually use that as well to get a little money off as well. So we want to talk to you about that today. Now, the home I own, and just to give you an example too, when it comes to like a benefit of buying your home versus particularly renting, right? And landlords. So the home that I own would probably rent for about $2,600 a month, right? So it'll rent for that. But I bought the home for much more than that on a monthly basis, and that includes my taxes and my insurance and all that stuff, right? So I bought it for more for less, and it's less than that on a monthly basis. So that difference for me, if it was to rent for 24, if I had to pay, $2,600 a month for it, the difference for me is a car payment. It's a car payment. So if you look at it like this, I could have rented this place. It's the same place, got the same number of rooms, got the same high ceilings, got everything else. It's the same. I could have rented the place and paid, let's say, $2,600 a month for it. I could have did that, or I could do what I did. I bought the place. And the payment is much less than that. But let's say that total of $2,600 that I would have paid if I would have rented it, that total of $2,600. With that total of $2,600, I can and I do own the place. So I've got my roof covered, right? And that's my car payment. So that $2,600 to me is like a twofer. So I got two things, two of the biggest expenses that the typical person has: a home and a vehicle. I got two things for the same amount that I would have paid if I was renting. So that makes a difference to me. That gives me peace of mind when it comes to that as well. I feel like I'm winning. So that's a win-win as far as I'm concerned. And if you look at it that way, then you'll maybe start rethinking. There's other things that come along with home ownership. Your air conditioning goes out. You got to fix this, you got to fix that. But hopefully, if you keep up your maintenance on the places, you don't have to do that often, and it doesn't cost you as much in the long run. You'll come out better in the end, especially when you talk about tax benefits and all that stuff, and just the peace of mind of having your own space, if that is important to you. So, what should you do? Now, let's talk about what should you do. So when the last straw happens for you, while you're renting and you say to yourself, I need my own space, whether that reason is because the neighbors in your apartment building are just too loud, you're tired of the rent going up every year, maybe your music is too loud. You like to play your music loud and your neighbors, they complain. Maybe your neighbors are just nosy, and every time somebody comes over your house, they're looking out the window to see who's coming to your house. Maybe they're just nosy. Maybe you gotta warn your neighbors. I'm having some people over tonight. Please don't call the police over on us. We'll be done laughing and having a good time. About 1:30 in the morning, whatever it is. All those things, whatever it is, that's when you start looking to improve your credit. That's when you start looking for improvements of your credit. I don't care if you even have a decent credit score. A 680 is a decent credit score. You're sitting in the fair range, right? You're sitting in the fair range. If you're at 680, that's a decent credit score. But maybe with just a few adjustments, you might be able to reach a 715, a 720, which will give you a better interest rate and then a better payment as well on the biggest purchase that you're ever going to make. So you want to start looking at your credit as soon as that last straw hits and you decide in your head, I want to buy a home. That's when you start to do it. All right. So as soon as you're thinking about buying that home, that's when you start working on improving your credit. Now, almost simultaneously at the same time, that's also when you start saving money. Absolutely, you need to start saving money for your down payment. The question always is, how much should I save? The answer is as much as you can. Absolutely as much as you can. If you save more than what is required, then that's a good thing. Then you got extra money to do whatever else you want to do. You want to do after you get into your new home, whatever that is. So the mortgage company wouldn't require, let's say you save 15,000 bucks. The mortgage company is not going to require you to give them $15,000 down on your home just because that's how much money you've saved. That's just not how it works. If they only require you to put $10,000 down, then they're going to take their $10,000 and they're going to go and skip away, and they'll be happy with their $10,000. Now you got $5,000 left over that you've saved to do whatever it is that you need to do with it. So having more is absolutely better. So how much do I? So how do I know how much do I need? Well, if you can put 20% down on a home, that would be absolutely great. When it comes to homes and mortgages, a lot of states require you to get PMI, which is private mortgage insurance. That insurance is basically you're paying insurance for the lender, for whoever finances your home. You're paying insurance for them just in case you default. In case you don't make your payments, and they got to take it back and do all the things that they do to get the home back, you pay insurance for that when you don't put down 20% of the purchase price of your home. So if you can put down 20%, great. Keep in mind, a $200,000 home, that 20% is $40,000. So if you got $40,000 laying around and that's what you want to do, knock yourself out and do that, or you're going to have PMI, which also adds to your your mortgage payment in there. So if you can put 20% down, cool, but you don't have to do that. You don't have to do that. Actually, for the common person, for the average person, it's almost impossible. PMI insurance is on a lot of mortgages, a high percentage of mortgages, because people don't typically put down 20% with the cost of homes being what they are today. It's not 1985 where you can get a nice, decent home for, $50,000. It's not that anymore at all. So $2,000 home, $200,000 home, 20% down, that's $40,000. So if you don't have that, no problem, because there's other things, right? There's other ways. If you're asking me, what should I say? Let's keep with the $200,000 home. 5%. Let's do 5%. There's mortgage programs out there that let you do 5%. Some that'll let you do 3.5%. Of course, there's first home buyer programs, and some no money down programs that may not be as common as they used to be before. But let's look at 5%. 5% is a good one for you to target anyway. And if you go over that, then great. So on that $200,000 home that we're talking about, 5% is $10,000. So you want to try to be saving $10,000. Shoot for that. And if you go over that, that's great. That's absolutely great. And make sure that you put that in a bank account. Put it in a bank account, savings account, whatever. But make sure it's sitting there too, because when it comes to talking to your mortgage lender, they're going to see that money. They want to see that money sitting there. They don't want to see it all coming flooding in your account at one time. So make sure you start doing that when you start thinking about your home. You start building that savings for that, because anything extra, anything over that 10 grand, if you don't need the 10 grand, or if it's just 10 grand, anything you save is just gravy. You can put it in your pocket. You can do the other things that you want to with the home, because it's always things that pop up when you move. I don't care if you're moving from apartment to apartment, or if you're moving into a home, there's always things that pop up, things that you want versus things that you need, but there's always things that pop up. And I'm going to suggest you use a mortgage calculator. Just go to the internet. You can put in mortgage calculator, and you can figure out how much a payment will be on a $200,000 home, how much a payment will be on a $125,000 home, how much your payment will be if you're buying a $500,000 home. You can go figure those things out. You can put in how much you'll put down. Typically, they default to that 20% we were just talking about. Put it down to 5%, so you know how much money you got to bring, and then you can start calculating how much your payment's going to be with taxes and insurance included. So get to the Google machine and find your mortgage calculator to do so. Number 3, what you want to do. You want to start looking at websites for homes. Start looking at them, see what you like, see what areas you like, and get a sense to how much do they cost. How much do those homes actually cost? How much the tax